guys, welcome back to the Capital Mindset Show. We're going to be going over a subscriber request to review another creator's portfolio, a much larger creator, and that is Everything Money, specifically Paul. So the reason why this video is coming out now is it's time sensitive. They just released their video, and well, not too long ago. And I wanted to cover this stock request. So this doesn't count as a typical stock request. I also made a huge adjustment. So if you guys were by chance wondering why there were no videos over the weekend, which there usually are, it's because I was making some major changes to the back end of the valuation model you always see here on the channel. As well as a quick update on that. Speaking of, the release, for those of you who may not know, will be around August along with the website and everything like that. So the website's down right now, but I'm really excited to show you guys what the model's kind of looking at on the front facing side with regards to the sheets that we use here. And I had a question one time that this is kind of pertaining to this. If someone would like to copy the layout of the model, and yeah, you can copy the layout of the model. That's just a look, it's what's under the hood that actually matters. So, the hood is the front facing part, what we see visually that makes it, look nice and stuff. It's just a Google sheet at the moment. And then we're going to turn it into a software and a website. So I'm working with the developer. Him and I are working very closely, and we're going to get that out by August. I'm really excited again to show you guys some of the new features. Some of them may be overkill. There's a new feature coming that I'm working hard now. It's going to probably take me about a week or two to finish up, where we can break down ETFs and see every single one of their holdings and kind of filter through all of them very quickly. And also I can start to do aggregations of what stocks are moving post-market, pre-market, and all that stuff. So all that's really interesting, where it's coming. All right. Anyways, with regards to this video, I want to actually cover some key points before we get into this, and regarding value investing. So Paul calls himself a value investor. And by the way, none of this video is a dig at them or meant to be demeaning towards them or anything like that. So I apologize in advance if anything comes across as that. But Paul calls himself a value investor. He may very well be, by the way. And I just want to cover what people think of when they think of value investor. And I want to kind of dispel those theories or myths. So people, when they think of value investors, they think of people who buy low PE stocks, right? And for a lot of stocks that we've covered on this channel, we've seen some stocks that are low PE, but they're not actually value, because under the nuance, and that's hopefully what you get from this channel, is that investing is very nuanced, right? Every single investment has a different approach that you have to take. A company is very unique. You have to actually understand the business, where it's going to go, what could happen, like all that stuff. It's very nuanced. So a company, for example, that's 100 PE, we're using PE because it's a simple metric everyone can agree on. 100 PE, 50% growth for 10 years, right? Or let's say 100% growth for 10 years. That's actually a cheap stock, right? Even though it's 100 PE, because if for the sake of argument, we can guarantee that it will grow at 100% from its current base at 100 PE. As you go along, it's going to grow into its valuation. In fact, that would probably be a value stock. You could consider that a value stock. And I'm making the assumption that it's a guarantee, right? Of course, nothing is guaranteed, but Peter Lynch was kind of trying to express this in his PEG ratio, right? So the PEG ratio adds that level of nuance that includes growth into that factor. So when you factor in growth, you kind of come up with a different assumption. And then, so a lot of people think value investors are the X, and then growth, and value investors sometimes think growth investors are just hype investors, right? So I like to say that those don't really exist. Our human brains are actually predisposed to categorization. So we like to categorize, and has uses to categorize. However, in investing, you kind of want to dispel those categorizations, and you want to actually come and take a step back. And I think, for example, you want to be just an investor, and everything can be a good investment at any point under the right circumstance, right? And then if you put a gun to my head and say, like, what does that mean? Well, I say, basically, I kind of agree with a lot of super investors, and they say all investing is value investing. It's just the way you define it may be weird, right? And the industry likes to define, again, growth and value and separate the two. Momentum, I think, is its own thing, right? Momentum is definitely its own investment strategy. But I think growth and value, as far as if you invest in fundamentals, there's just strictly, if we define it more properly, it's just value investing, right? Except I just don't agree with what the textbook says is value investing, right? And I think that way of investing is quite silly, in fact. And then I think growth investing, according to the textbook, is also quite silly, right? So I think just a broader range of investment strategies, okay? So on that note, let's actually get into the model and kind of talk about some new things going on. So when I pull it up, I'm going to actually pull up two things, because we want to look at the stock prices at the same time of the analysis. And the first one we're going to look at is Intel. Okay, so I'm pulling up the INTC. and I'll share that with you guys here. Let's go. So Intel right here, it's actually down 5% today. Interesting. And it's actually down quite a bit over the month. It's down 13%. And this is one that I had sold. And by the way, I want to make a point of praise to you guys. So when I sold Intel, I said so for my reasons. I sold it in the 50s and I got some criticism. Well, when you guys give criticism, you guys give really good points. So I really like when you guys give me some feedback in that form, because it shows me that the audience that is cultivating around capital mindset is one that is really trying to get to the bottom of things, to evaluate businesses, et cetera. And they come to me with really good points, counterpoints, and that actually builds the conversation around these stocks, which is actually what I strive for. I love that. So when, for example, I said I disagreed with their sale of Mobileye, a lot of you pointed out that they might be selling Mobileye at a premium, and that actually could raise capital that they need to further development. And they don't necessarily need to stop buybacks and dividends. However, I agree with that point. I just didn't agree with that management was unwilling to sacrifice the dividend for the short-term pain for the long-term gain. And that showed me that management was more focused on price stability of the stock rather than allowing the crash to come, maybe continue the buybacks and buy it at a cheaper price, but instead allocating that capital to just strictly investing in CapEx and building out their facilities, et cetera. Now, the Mobileye unit could do that, right? And I think it could do that. And maybe we want to make the argument that the management will do a bad job at managing Mobileye, but that's, what are we saying with that argument? We're saying that Intel's management might be a little bit incompetent to micromanage certain things. Well, not micromanage, but manage multiple things at the same time, which is maybe fine, but those are some of the key arguments. Okay. So now taking a look at some key changes. By the way, I want to take a note. There's one international stock that we're going to be covering today, and the currency converter is not fully operational on everything. It's just going to be operational for the actual valuations, but not some of these ratios down here. Okay. So just keep note of that. If you guys see something that's suspicious, yes. Also, some of these other features that they're not showing up, it's because they're right now out of commission. They will be in commission over the course of the next couple of weeks. Okay, so with Intel, the cash flows look really small. Taking a look down here at the visuals, we can see that there's this glut here, and this estimates are definitely going to come down. What I want to point out here is, I was discussing this earlier, the CapEx, right? CapEx investment is inherently risky. And so the market's going to price that risk in, and that risk is going to come down a little bit, or it's not come down, but those estimates are going to come down. And it makes sense because the cash flows that you're expected to receive, right, as an investor are going to come down because they're being spent on CapEx. However, into the future, they should pay dividends, right? And then we want to talk about that in the form of a recovery percentage. I already did the math, so not to waste your time, but these are kind of my estimates as to what the company could grow percentage-wise to get that recovery in. So it looks like it's a lot relative to what they've done in the past, but I'm assuming that in the future, the CapEx will be reduced, right? So then I've averaged it out, and then I have the high end of 20%, which is a very, very strong estimate, and then an 11% on the low end, because we're assuming kind of a recovery back to normal. And then again, look at that drop, right? And that estimate's coming from analysts, and that's probably going to drop too as we get more and more information and more analysts release their estimations over the course of the year. So Intel, I kind of said that there are all these risks involved. And for example, if we discount it at 15 instead of 20, a little bit less, we can kind of see these buy ranges. I think that it's interesting in the 30s. That's where I start to get interested in Intel, me personally. I'd say that it's reached my level of intrigue now that it's come down about 13-ish%, 14%. I think it's actually down 14, almost 15% since my sell point, but that's not the point. The actual point there is, I think now we can price in a little bit less growth, a little bit of that risk in CapEx spending. And I want to see what they do with the GPU launch, et cetera, and all this stuff, and their new architecture that's coming out. I think it's Alder Lake architecture. So I'm really interested in seeing what they come out with. And then again, if their investments pay dividends in the future. So I'm always willing to change my mind, and I'm watching this. This is actually on my watch list. Okay. And then, you don't want to be fickle in investing, but you want to make sure that you can change your mind when the facts change. And then I'm willing to do that with Intel. I'm waiting because I would love to own something like this if they can execute. So I'm just watching them, but I think in the 30s, it starts to get really compelling. Okay. I think that at that point, the market's really being bearish on them. So that's kind of my thoughts with Intel. I used to own them. I sold them. It was an accidental trade. It was completely by accident. I will sell things when I just disagree with what management's doing. No ifs, ands, or buts. So Next one we'll go over is Facebook. We talked about Facebook in the past, and I might as well just show you guys this feature here. I think it's kind of cool, I guess. So here we can just immediately see the executive team, their gender, and when they're born, what's their compensation package if it's public, and what currency it's being paid in. So I think that's sometimes interesting. Let me know if you're in the comments if you're interested in seeing that stuff in later videos. So otherwise, I'll just skim over it. So Facebook, we've talking about it on the channel for quite a bit. I'll show you actually what my valuation was basically covering. Funnily enough, it's about these same percentages, so I'm just keeping them. And I have my portfolio position public. It's public, it's free, no one pays for anything. Just go see it. It's on the channel. You can probably find the video. It's titled Portfolio Reveal. And anyways, with regards to Facebook, I am buying quite frequently. Oh, by the way, with the portfolio, make sure you see when it was updated, because I don't update it every day. It should update in real time in terms of price action, but I have to always update if I buy new positions and change the share amount, right? So I have to enable or refresh it. So anyways, with regards to Facebook, it's quite interesting at these prices, in my opinion. I'm getting more and more interested in adding more shares to Facebook over time. I think that Facebook is, being a little bit mispriced here. I understand the sentiments. I read those comments, by the way. I can really understand that sentiment against Facebook. It's just I'm investing it for different reasons. And again, trust me, I understand. Okay. Anyways, with regards, I'm really excited for Facebook if it gets into the 167 and below. And that's actually again, I talk about that in the sheet, or not. I talk about it. There's no commentary on it. It's just the strategy that I have. And then, so if it gets down there, I will definitely be adding a lot to this position, because I think at that point I can, fairly assume that that's it can grow at. All right. So that's Facebook. Me and this individual, we agree, I guess, on a lot of Facebook. I just don't agree necessarily on their valuation model. I took a look at how they evaluated it. I thought it was meh, it was okay. But we agree on a lot of the fundamentals. So again, and I'll go over again, like a final verdict on every single stock towards the end. Okay, so the next one is BABA. So BABA, I've talked about it extensively. It's a VIE. I'm like about it. So again, the currency conversion is affecting the valuation up here. Some of these other stuff, it's not actually affecting. So for example, this book value, it's not accurate. If you want to be precise, just divide that by the yen conversion, and then you get the actual book value. So it looks like it's a crazy book value, but just so you guys are aware, it's not actually affecting. That's actually technically in yen, not dollars. So if we take a look at some of the concerns I've had, you can guys go watch that video. But in summary, it's a lot more nuanced than the traditional argument against the VIE structure. I think when they argue that the VIE structure is not a problem, they're not actually addressing any of my points. They're addressing mainly the mainstream media's points, or some talking heads points, which I think is kind of a surface level, not everything money's the talking heads. So I think that, for example, we just have a fundamental disagreement on this. I am long, and the reason why I am long is I literally think price will just go up because we saw the drawdown in Chinese names in 2021, and that was the liquidity crunch that we were discussing. It had nothing to do with the VIE. Everyone was misunderstanding all that schnaz. And then maybe there were some concerns with the government itself, but not really with concerns with the VIE structure per se. It was more the liquidity crunch. And then now I think we're exiting that period in 2022. I've already addressed why. The video is titled "The Year of BABA," and so I kind of addressed those points there. So I think that price action will be favorable, and the United States is going through its liquidity crunch right now. We're discussing about this. The only, I won't get into it. To keep this this video kind of brief. All right. So next one I want to cover is SCS, right? So SCS. This is let's actually wait it to load. Load. But okay, so basically while it's loading, I'll just talk about it. This is definitely a cigarette butt investment stock. I'll show you guys down here. So it's very cyclical, right? In the cash flow. So in the cash flows are expected to grow, but growing off of a very small base. And you can kind of understand that they sell office furniture, and so a lot of the sales were actually brought forward in 2021. A lot of cash flows were realized, and you can see in sales that they kind of peaked out in sales, and they're kind of still recovering. So they're not gonna recover for a while. I'd say that you got to be very careful with a stock like this. It's in this portfolio. it's interesting. It's a cigarette butt investor. So if the sentiment changes, I think it actually can come out favorably. But based on the fundamentals, I think it's a very high risk. I wouldn't say a retail investor should even be concerned with something like this. Someone who has a lot of money, which apparently this guy has a decent amount of money, maybe it could be something in the portfolio that you want to throw money at and see if it works. But as far as a long-term investment, definitely not. If we take a look at, for example, at the price action, we say people love to say this quote, but let's put stock. But the market is a weighing machine over the long periods of time, and we can see that the market has definitely weighed this as a terrible business. You had to basically buy this in troughs. And who's the market timer? If you're the market timer who did this, call me and I'll give you a job. So right here, yeah, you see, if you did this, you probably outperform the market. But over long periods of time, you're probably going to perform the market in this kind of business. It's just not a good business to be in. Now, its twin brother that he's also invested in, which I found very interesting because I don't really know his allocation percentage. Which I also wanted to take a quick pause here and address that Alibaba, he did not say. He says in some videos, I guess, because I got that in the email, that it's a small portion of his portfolio. However, he's made it sound sometimes that he's invested a lot of money in Alibaba. And then so this individual who made this request is concerned that Paul is changing the percentage. I'm not going to assume that. I'm just going to assume at their word at what they said in the video that the allocation is small. So just want to actually address that. I actually don't know what any of the allocations are to any of these. I only have this notes to go off of. So yeah, with regards to MLKN, it's it's kind of, let's take a look at down here. Yeah, so definitely cash flows are being brought forward. So I'd be very careful because we see revenues are actually declining. So this cash flow probably coming from payments secured previously, right? Sales secured previously. Going forward, I don't know. I'm not really going to trust this cash flow growth going forward. And even with that, I mean, man, we're really it's really not, you really don't have a margin of safety. So I'd rate that one. I'll give you the rating at the end. Last one is Walgreens, right? WBA. Well, actually, no, there's one more. There's the gun one. So Walgreens Boots Alliance, we have, these assumptions. I think they're not really the assumptions. I haven't changed these assumptions. So let's actually put in some realistic assumptions. If I'm being honest, Walgreens was one that I talked about, and I had a question that, why isn't Walgreens in the portfolio? It's because I sold it. It was part of the sales to actually prepare for the liquidity crunch that I thought was going to occur. Hindsight, it kind of did. We're still, I don't know if we're out of it yet, but it's good to prepare it. And I wanted to take my profits off of Walgreens. There were a lot of added risks coming forward. Again, I don't really post my trades. I'm not selling you my trades. I'm not going to do that. So with regards to that, I mean, my portfolio is public. I will update it when I do update it. But yeah, Walgreens hasn't been in the portfolio since I think it was late. I think it was late December. I'm pretty sure. I'd have to check that, but it's late December, January. I think it's late December, which I kind of eliminated the position. But going back into Walgreens, I mean, because the price is coming down. I mean, it doesn't have to grow that much, but the thing is, the growth I think is very tamed into something like this. So you'd have to really lower your expectations. And if we're actually being honest, if I think a 5% is a lot for something like Walgreens. The price I bought, it was in the 30s, and it was in 2020. So my buy price is very vastly different from this. I don't see it really compelling at these prices in terms of outperformance, right? Because I want a higher margin of safety than that. But if we lower, kind of our expectations, yeah, you could argue it's a good value. But I think the 5% is probably on the high end. And if we're being honest, like 3, and then like negative 2% is probably on the lower end. And yeah, if I remember my analysis correctly, I think I was pricing in almost close to a decay at those prices. So that was a deep discount. Okay. And I think there was over pessimism on Walgreens, and it had to do with Amazon getting into the business. Amazon has launched a competitive-esque product, not product, but a service. But it's not going to kill Walgreens, in my opinion. Well, at least for now. My mind will change if the facts change. But yeah, it's interesting business. Yeah, they are estimated to actually decline. So you see this decay is actually probably likely. And that's what the market's kind of pricing with this drawdown. But, it's yet to be seen. I haven't dedicated a deep dive analysis into this. So I'm just going off of what the numbers are saying and honestly what analysts are projecting here. So that one's interesting, but I don't really know what price. I actually didn't write that down, what price he bought this one at. So if he's still holding on, maybe he'll be fine. All right. So I think the last one is this gun company. All right, so this one I already did a video on. I also did it on its, in my opinion, better run twin brother. This is cigarette butt investing. I think I saw that they also did an analysis on Corsair. A lot of the same opinions that were expressed by a lot of people, which was a lot of demand was brought forward. And that was a concern to them. I don't know why they didn't apply the same logic here. I think that was a newbie mistake. So I think the exact same thing is occurring with Smith & Wesson. And in fact, this is a not really well-run business, in my opinion. And it is high risk. Could it work out? Yes. Will it work out? I don't know. Just taking a look at these charts right here, you can kind of see exactly what I'm talking about. So analysts are really bullish. They're estimating all these things, right? They're estimating actually higher than 2021. Okay. If that happens and it continues to grow, this is incredibly cheap. Will that happen? I don't know. I think actually this is going to come back, right? Something around this is going to be the real situation that occurs. And I would not like to participate in that. There are other stocks that I could buy. Could it happen? Maybe, but will it happen? I don't know. I don't think so. You can see that this is really cheap stock. I mean, I think in the original video, I made that point very clearly. So we can decay this thing, I think, to kingdom come. And I'm already discounting at 25%. Yeah, you can decay this thing like crazy. Let me see, 10%. Okay, fine. At 10%, it could decay by 10% every year for 10 years. And a discount rate of 25 still gives you that close to a buy price. So, and you see it's tricking the model, because I'm assuming all these things. And then it looks like it's not risky in terms of bankruptcy and all that. So, that's why I don't trust this like a religion. It's kind of like a taste test to see, what should I allocate to it? And the model kind of gives me its opinion, then I make my own opinion. So this is a machine. It's not human, so it cannot imagine, right? That's if I could program something that could replace human investor, yeah, and that'd be I'd win a Nobel Prize. I'll tell you that right now. So yeah, with regards to this, I would avoid this. I'm avoiding this. If you're invested in it, I mean, you have your own reasons. Okay, so I'll cover that. So I'll give my final verdict. Again, remember, this is not a dig on them. I'm just doing this because the subscriber requested it. So the first one, Intel, okay. Investment, I think it could turn out really well. Analysis on it was okay. Facebook, I like the business too. I agree with a lot of their bullish points. Facebook, however, as a valuation that they did, meh on their price targets. I'd say that was kind of a lot of rookie mistakes, I guess. That's all I'll say. Alibaba, fundamentally disagree on the VIE structure. Their arguments actually never addressed any of my points. So I can clearly see they probably maybe don't care or understand. I think it's leaning maybe they don't care, because I think they are intelligent individuals. So that's with Alibaba. SCS and MLKN, cigarette butt investments. I think they're really difficult to wrap someone's head around. Maybe this guy's a genius. He's the next Buffett. And so he understands, because cigarette butt investing is what Buffett did, by the way. So maybe he is that. And then, so he's going to turn out really well and outperform the market then. And then SWBI, I think that's a noob tier mistake. I think that, you need to apply the same logic that you applied to Corsair to that stock. So I think of all these businesses, the only one I think there's only two solid businesses, which is Intel and Facebook. I think the other ones are pretty meh. Walgreens is kind of a quasi solid business. It's kind of a solid business that has to kind of prove itself again. But again, there's a price at which it is good. That one, I think, is that old textbook value stock, right? But again, like I said at the beginning, is it a value? You got to be careful with those risks. So that's kind of my thoughts on that. And with regards to what we do in the future, going forward in the future, again, all of these, they could turn out well enough. My personal opinion, I think that this selection of stocks is going to underperform the market. I'm just going to be blunt. Even though it has Facebook, I mean, I don't know the allocations. I got to be honest, I don't know the allocations. But I think aside from Facebook, most of these stocks, well, actually in BABA over the short term, in my opinion, these probably will underperform the market in aggregate. If they do outperform the market, it's because the risks that I kind of highlighted do not actually pan out. And then so again, but you are actually going to get compensated for that risk. Okay. So never, when you get a return, it's never free. If you get a lot of return, you might have actually were putting down a lot of risk, right? You're being compensated for putting on risk. So if it turns out really well for those cigarette butt investments, it's because, you know, that risk that this individual is putting on. On that note, guys, I hope you guys enjoyed this video. If you guys like this video, go ahead and feel free to leave a like. If you're not subscribed, go ahead and subscribe, and then be sure to come back for more content like this, or, you know, our typical stop request videos. All right, guys, I hope you guys have a great one. I'll see you guys in the next one.